Hey everyone, welcome back to another StoxCompare explainer. Today, we're popping the hood on a company that's pretty much defined consumer growth over the last 20 years, Monster Beverage Corporation. We're going to put this beast through our usual institutional grade teardown. We really want to see what makes it tick, how it actually prints cash, and most importantly, what the data is telling us about where it's headed next. 95.6%. Honestly, I just want you to let that number sink in for a second. Before we even get into the weeds of the balance sheet, we really have to acknowledge the sheer scale of this stock's momentum. I mean, that is a massive 5-year return they've delivered to shareholders. It's completely outpaced the broader market and basically left traditional beverage competitors eating its dust. Okay, let's dive right in. Think about the sheer trajectory of this momentum. We aren't just talking about a 5-year run here. We're looking at a staggering 47.58% return over just a single year. It's the kind of trend line that just screams market dominance. But look, as focused investors, we know that just because a stock goes up and to the right doesn't mean we should blindly buy in.
So it begs the core question, the one that's going to frame our entire teardown today. Is this unstoppable, fundamentally backed business momentum? Or is the market simply pricing in absolute perfection? You know, when a stock runs this hot, your margin of safety gets really, really thin. We need to figure out if the underlying financial engine actually justifies all this hype.
Here's our roadmap for the teardown. We'll start by checking out the momentum, then break down the revenue engine and capital efficiency. After that, we'll audit their fortress balance sheet, weigh the valuation risks, and wrap it all up with our final StoxCompare verdict. Section 1, the momentum question. Let's evaluate the beast. Short-term performance is definitely validating the long-term trend, right? We're seeing a 24.26% bump year to date. But the real meat is in the investment thesis itself. We've got 3 main pillars here. First, there's this relentless top-line compounding, projected to reach $8.29 billion in 2025. Second, an incredibly asset-light balance sheet that really shields them from volatility. And third, what we like to call the premium conundrum, evaluating if this flawless execution actually justifies their historically high valuation. Moving on to Section 2, top-line growth and margins. Let's look at the revenue engine. Now, a perfect staircase of caffeine-fueled, compounding revenue is exactly what you want to see as an investor. Seriously, despite inflation and all the shifting consumer habits lately, Monster has just marched upward without missing a beat. They've compounded reliably from $5.54 billion back in 2021, and they're tracking to hit a projected $8.29 billion by 2025. But hey, generating sales is one thing, right? Keeping the profits is a whole different ballgame. Back in 2022, some supply chain issues dragged gross margins down to 50.3%. But the recovery trajectory is what's key here. They are projected to bounce back up to 55.8% by 2025. So why does this matter? Well, it tells us that management successfully passed their increased costs right onto the consumer through price hikes, and they did it without destroying demand. That is literally the definition of a wide economic moat, leaving them with a wildly impressive 29.17% operating margin. All right, Section 3, capital efficiency and cash, the multipliers. 79.3%. I really want you to take a moment with this number, because in the world of corporate finance, seeing a metric this high is just incredibly rare. Now, what's really interesting is that 79.3% is Monster's projected return on invested capital for 2025. Back in 2022, it was 46.8%, which, let's be real, is already fantastic, but it has absolutely exploded since then. This means that for every single dollar management invests back into the business, they generate a near 80% return. When you pair that with a 25.7% return on equity, it just proves total management mastery when it comes to compounding shareholder wealth. So what's the secret sauce behind this explosive return metric? It's their asset-light model. Monster doesn't actually own massive capital-intensive bottling plants or huge fleets of distribution trucks. They outsource all that heavy lifting. By avoiding tying up billions of dollars in physical infrastructure, they severely minimize their capital expenditures. And this asset-light approach, it turns the business into an absolute cash machine. Because they outsource the bottling, they pull in a massive $2.10 billion in operating cash flow. But since their CapEx, their capital expenditure, is incredibly low at just $0.153 billion, almost all of that operating cash drops straight to the bottom line. That leaves them with an enormous $1.94 billion in free cash flow. Section 4, Fortress Balance Sheet and Capital Allocation. So, the natural next question here is, what exactly is Monster doing with almost $2 billion in free cash flow every single year? Well, first off, they hoard it to protect the castle. They are sitting on a massive $2.77 billion in cash and equivalents, weighed against a tiny little sliver of just $0.13 billion in total debt. That's a debt-to-equity ratio of practically zero. With a working capital ratio of 3.70, they have virtually zero liquidity risk. If the broader economy crashed tomorrow, Monster's operating from an absolute, self-funded ironclad fortress. But they aren't just letting that cash sit around gathering dust. They have a very aggressive, super specific capital allocation philosophy. Zero dividends, 100% buybacks. They really don't want to hand you a taxable dividend payout. Instead, they want to force the value of your existing shares to go up. The crucial point here is just how aggressively they are shrinking the share supply. Back in 2021, there were 4.23 billion shares outstanding. By 2025, that is modeled to drop to 3.90 billion. In 2024 alone, management deployed an astonishing $3.69 billion strictly for share cannibalization. By forcibly shrinking the supply of shares on the open market, every single share you own represents a much larger slice of that $8.29 billion revenue pie. Section 5. Valuation and market risks. The climax. This brings us to the toughest question of all. Is this absolutely flawless execution already entirely priced in by the market? So here's the premium conundrum in a nutshell. Over the last 5 years, Monster has traded between a 14.56 and 18.15 price-to-book multiple. And right now, we're sitting at the absolute ceiling of that range at 18.15x. Does a nearly 80% ROIC and a zero debt balance sheet justify paying 18 times book value? History definitely supports paying a premium for this kind of quality, but when you're at the absolute top of the historical range, your margin of safety gets razor thin. It is quite literally priced for perfection. And we all know perfection is incredibly hard to maintain, especially when you face this kind of risk-reward matrix. Sure, the growth catalysts are massive. You've got a huge international runway, successful extensions into alcohol, and this unbreakable moat of pricing power. But the market risks are just as real. They're locked in an intense energy dogfight with aggressive new entrants like Celsius fighting tooth and nail for shelf space. Plus, when your valuation is this high, even a slight slowdown in growth can trigger a violent multiple contraction and a rapid correction in the stock price. Finally, Section 6. The final investment verdict. The resolution. All right, let's bring it all together for the final StoxCompare scorecard. For growth, looking at that projected $8.29 billion in revenue, it gets an A+. Profitability, driven by that unbelievable 79.3% ROIC, is an easy A+. The balance sheet, sitting on nearly $2 billion of free cash flow with zero debt, undeniable A+. But valuation gets a C. Because of that premium multiple, our final rating is a strong hold, or basically accumulate on DEPS. The execution here is fundamentally flawless, but smart investors should really exercise patience and wait for broader market discounts before establishing new large positions. So what does this all mean for you? Looking at the data, do you agree with our strong hold reading, or do you think that 18x multiple means it's time to take profits off the table? I want to hear from you. Let's debate the thesis down in the comments. If you found this teardown valuable, make sure to subscribe and like the explainer so we can keep bringing you this level of focus and clarity. Until next time, stay disciplined and keep learning.